Schedule F, profit or loss from farming. So this is a schedule that you would use if you had farming related activities that you either generated a profit or you generated a loss on based on goods that you sold if you materially participated in the business. So generally, this is the tax form that you would file as a farmer. That would then help inform other parts of your income tax return, such as Schedule SE for self-employment. So there are 4 parts to this schedule. We'll go over each of them in a little bit of detail. We've got Part 1, which is the farm income cash method. Part 2, farm expenses for both the cash and accrual method. Part 3, which is farm income for the accrual method. And then Part 4 is principal agricultural activity codes. So we will go over Part 4 first, mainly because we need some of this information when we start completing Part 1. So basically, these are the principal agricultural activity codes as provided by the North American Industry Classification System, NAICS. So you can choose one of several different activity codes, and then you're going to enter that activity code in line B. So as you can see here, we've pre-filled this form, and it happens to be the activity code that corresponds with beef, cattle, ranching, and farming. So our hero in this story is John Doe, and he is a beef cattle farmer. So there are a couple of other notes that we should at least go over. So you're not going to file Schedule F for certain activities. So one, if you generated income for raising or breeding pets, if you provided agricultural services such as soil testing, veterinary services, if you worked on a farm, if that was your primary source of income, in either of those cases, you're going to complete Schedule C instead of Schedule F. If you produced income from managing a farm for a fee or on a contract basis, like if you had to manage a farm but it wasn't your farm, you would also use Schedule C. And finally, if you sold livestock for the purpose of breeding, sports, dairy purposes, draft, those are all considered business property, and you would use IRS Form 4797, which is the sales of business property form, to report those transactions. So that's really all you need about Part 4. In our article on the website, we do provide a little bit more information under each of these principal agricultural activity codes as they're defined under the NAICS system. So this kind of helps the federal government keep track of, in a broad sense, different industries. So with that said, we are now going to move over to the top of the form. So at the top, we have our hero's name, John Doe, his social security number, and as we mentioned, his principal crop or activity is raising beef cattle specifically, and that's the NAICS code. He operates on the cash system. And as a sole proprietor, he does not have an employer identification number, but according to the form instructions, you probably don't need one unless you meet one of the following criteria. If you have a qualified retirement plan, if you're required to file employment, excise, alcohol, tobacco, or firearms tax returns, or if you're paying out gambling winnings, you don't need an employer identification number. You certainly don't need one as a sole proprietor unless you specifically requested one, which you can do either on the IRS website or by filing Form SS4 with the IRS. You can get an EIN online within about 5 to 10 minutes. If you entered a Social Security number and you don't have an employer ID number, then leave that blank. Don't put your Social Security number in the EIN line. So for line E, the question is whether or not you materially participated in business operations. If not, if you did not materially participate, then there may be a limit because the IRS will deem this to be a passive activity, and generally passive activity losses can only offset gains from other passive activities. So if you didn't materially participate in your farm, like you had it on the side, but your primary job was running a software company, then you would not be able to offset any of your income from the software company if you had farming losses. If you had two farms and one generated a profit and the other one did not, and you were not a material participant in either farm, then you could use the losses from one farm to offset the profits from another farm. So there are limitations on passive activity losses, but there are also rules on what defines material participation. So you can either find that on the IRS website or in our article. We go into deep detail about the seven different tests that someone may be able to use to demonstrate material participation, and that helps avoid the passive activity loss limitations. In line F, did you make any payments that would require you to file Form 1099? So specifically, anyone that has to issue 10 or more informational tax returns, such as 1099s, generally have to do so electronically. But I would also say if you answer yes here, you definitely need to answer yes to Part G unless you would like to welcome an audit. So this is one of those kind of no-brainer selections. If you did make payments and you're required to file IRS Form 1099, and then you turn around and answer no, that you will not file the required forms, then that's a mistake you can avoid. So that's all we need to cover for this taxpayer information at the top of the form. Now, when it comes to farm income, you will either use the cash method, in which case you would use Part 1, or you use the accrual method, in which case you would report your farm income in Part 3. So we're going to walk through each of those separately. We've basically kind of made the numbers work the same, but the primary difference is that cash method taxpayers will report income and expenses in the tax year that they are actually received or paid. So conversely, the accrual method, the taxpayer earns or income or pays expenses in the year that they're accrued. So let's walk through an example. If John Doe did $10,000 worth of work in December of 2022 on another farm, and this was reported as, let's just say, other income in line 8. Now, if he received $5,000, finishes the work, and he's earned $10,000, but for some reason Farmer Dean doesn't get a chance to pay him until 2023, then John Doe would report that he received $5,000 because that's the cash that he received in that tax year. However, under the accrual method, he would report that other income as $10,000 because that was actually all earned in 2022. So cash method works for small businesses. It does become a little bit more cumbersome for larger businesses, and the IRS actually has rules on when someone can select to use the cash method versus the accrual method. Virtually every significantly large farming operation or Fortune 500 company for that matter uses accrual method accounting, whereas cash method is kind of exactly what it says. I do work. If I didn't get paid for it, I'm not going to report that income until I actually receive the money in my hand. Or if it's if it's in an account that I have access to, or if I received a check that I can deposit, that all means that I have access to that cash. So we're going to go through part 1, and then we'll circle back to part 3 and kind of walk through some of the similarities and differences, and then we'll circle back and go through part 2, which kind of helps us report our net profit or loss from farming. So in part 1, in lines 1A through C, we're going to basically report the sale of purchased livestock and other resale items in line 1A. And we're going to back out the cost of those items in line 1B, and then we're going to subtract the difference. And that's basically what the profit we received from those items, from that livestock or other resale items. Now, in the form instructions, you might be, it does cover a scenario where you might be forced to sell livestock because of weather conditions. So you can choose to report income from that forced sale in the next year if you meet 3 criteria. 1, if your primary business is farming. 2, you have documentation or you can show that you only sold the livestock because of weather-related conditions. And 3, if your area qualified for federal aid. So under those situations, you might be reporting, if this is a 2022 tax form, you might be reporting this from a 2021 tax period that you chose to defer for tax purposes. So in line 2, instead of reporting the sales of purchased livestock, you're reporting the sales of livestock, produce, grains, and other products that you actually raised. You planted it from seeds. You raised this on your own. You didn't buy a cow, fatten it up, and then turn around and sell it on the market. In line 3A and 3B, and pretty much down here through the end of line 6, you're going to see a column for A, column for B, and generally when you see left and right columns like this, there's an amount that you might see on an informational return. For example, line 3A, you would receive a Form 1099 PATR. So that amount would be the total amount that you received, and then line 3B represents the taxable amount. So for cooperative distributions, you might have received a Form 1099 PATR. So line 3A represents patronage dividends, non-patronage distributions, per unit retain allocations, and redemptions of non-qualified written notices of allocation and per unit retain certificates. So on line 3B, you're not going to include certain items as income. So you're not going to include patronage dividends from buying personal or family items. You're not going to include capital assets or depreciable assets. They might be reported in 3A, but it's not taxable. So in line 4A, you're going to do the same thing when it comes to agricultural program payments. you might receive a certain amount from the government, and then you're going to report both that and then a taxable amount of that. So such government payments might include price loss coverage payments, agricultural risk coverage payments, coronavirus food assistance program payments, market facilitation program payments, market gain from the repayment of a secured commodity credit corporation loan for less than the original loan amount, diversion payments, cost share payments, or payments in the form of materials. So if you received fertilizer or services such as grading or dams, those would be reportable. Now on line 4B, you would only report the taxable amount. So you would not report any market gain from a commodity credit corporation loan if you elected to report the loan proceeds as income in the year that you received them. So because you reported it as income in a prior year, you don't need to report that as a taxable amount again. So those payments would be generally on form CCC-1099-G from the Department of Agriculture. So in line 5A, we're going to talk about a little bit more about commodity credit corporation loans. So in 5A, you're going to report the total amount of the loan proceeds that you received in the year if you did make the election. So in this case, John Doe elected to make $5,000 reportable in the current year, but then he also forfeited $10,000. So because actually we're going to make this a $5,000. So there we go. So in this case, he reports 0 loans that he received. However, he did, because he already reported that in a prior year, but he did forfeit a loan, and that forfeited amount also happened to be taxable. In line 6, you're going to enter crop assistance proceeds. So federal crop disaster payments that are, so again, the amount that you received would go in line 6A, whether or not you received them or elected to defer the receipt until the next year. So if you received $10,000, you decided to include $5,000 as taxable, you can check this box to make that deferral. And then we're also reporting, well, if we had any amounts deferred from prior year, we would enter that here. So actually, you know what? There we go. So custom hire machine work income. So this is work that you might have been hired to do specifically on a different farm that the other farmer could not have done themselves. You're going to report that in line 7. And then any other income items. There's a long list in the form instructions of types of items that you could include. So illegal federal irrigation subsidies, bartering income, income from debt cancellation. So if you do have to report that, you should find a form 1099-C or a similar statement by January 31st that reports how much debt was canceled. State gasoline or fuel tax refunds, any amounts that you included in income for either the biofuel producer credit or biodiesel, renewable diesel, or sustainable aviation fuel mixture credit. If you paid federal tax on fuels in a prior year on Schedule 3 and you received that credit, that's reportable as income. Inclusion amount on leased listed property. If that business use percentage drops below 50%, you have to claim some of that inclusion amount as income. Recapture of deductions or credits for clean fuel refueling or alternative fuel refueling property used in your farming business, income from breeding fees or fees from renting teams, machinery, or land that's not otherwise reportable on Schedule E, gain or loss on commodity future sales, or any payroll tax credit that you might have been qualified for. So you're going to total all of these up, all of the items in the right column, and then you're going to enter basically the total here. So this is your gross income from farming, and this I believe is $100,000. Now, if you use the accrual method, then you would take the line 50 amount, and even if you did not do this, all of this would look blank, and you would take the line 50 amount and insert it in line 9, because then you will use this to calculate your net profit. So we're going to go to the accrual method, and you're going to see similar lines, and we're going to go over them a little bit, I won't say, a little bit less detail because we've already covered them. So sale of livestock, produce, grains, and other products. We're going to cover a little bit more about that, but you'll see that line 38A looks very similar to line 3A. So a lot of these aren't changing, although you may be reporting them differently based on the timing of the receipt of certain payments. So in this scenario, these all match up exactly the same, and that's okay. The focus item that I really do want to look at is kind of how you generate the cost of the livestock, grains, and other products sold. So here, you enter the cost of all that here in line 1B, then you subtract it to get your profit from those sales. In part 3, you actually report the sales, then you have to calculate the cost of the goods that were sold, and your net profit is the difference. And you use a beginning year inventory and an ending year inventory to do that. So this is one of the main distinctions between the cash method and the accrual method. So in the accrual method, you'll enter your beginning inventory of livestock, produce, grains, and other products, but you won't include the sales of anything that was actually sold as business property. So anything under this section right here, sales of livestock sold, held for draft, breeding, sports, or dairy purposes, those costs would not be in here. This is simply the inventory, and I just came up with a beginning year inventory of $200,000. In line 46, you'll enter the cost of anything that you purchased during the year. So that results in a total of $250,000 of inventory. At the end of the year, we had $210,000 of inventory. And at the end, we back that out and we have $40,000 that represents the cost of goods sold. Now, up here, we reported all of these items. We arrived at $140,000. So we subtract the $40,000 and we come up with $100,000 of gross income. Now, I did this specifically for illustrative purposes. It is very, very highly unlikely that a farmer using the cash method and the accrual method would come up with the exact same numbers using both methods, unless you happen to have only charged for services in a year and you received all the money in that same year. You only paid expenses for a given year and you paid in cash, and those methods just happen to line up. But as most business owners know, there's usually something that happens at the end of one year, but you don't get paid or you don't get caught up or you don't have to pay the bill. You know, things like net 30, delivery, all of those things come into play when you're discussing the difference between cash method accounting and accrual method accounting. So this is a coincidence that I made these numbers line up exactly the same, but you would take this $100,000 in the farm income and you would plug it in here. So now we'll cover farm expenses, and I'm going to spend a little bit more time talking about what the instructions say and not so much time really focusing on the numbers. For each of these expense items, I listed $1,000 just so that you could visualize them, but I'm going to spend a little bit more time talking about each line. And then if the instructions don't discuss any particular line, we'll kind of give it a general mention and then move on to the next one. So when you're discussing farm expenses, don't deduct personal or living expenses, expenses of raising anything that you or your family personally used, the value of animals that you raised that died, or inventory losses or personal losses. So there are other ways to account for that, but not in the farm expenses. There are special instructions when it comes to capitalizing costs and other considerations about electing to deduct certain pre-productive periods of plants. So if you plant a tree and it takes more than 2 years for it to be profitable, you can elect to deduct the expenses instead of capitalizing them. But there are certain very specific guidelines on which type of crops you can do that with versus others. So just understand that there is a possibility for plant farmers, to deduct certain pre-productive period expenses so that you're not having to, you can take the tax advantage of that expenditure up front as opposed to waiting over a period of time to offset it against income that you haven't even received yet. So, and the other note would be for small business taxpayers, there are special capitalizing rules that apply to most taxpayers unless you're a small business taxpayer. You have greater flexibility in being able to expense certain items that you would otherwise have to capitalize. So generally, you have to have gross receipts of $27 million or less for the 3 prior tax years, and as long as you are not considered to be a tax shelter. There's a specific definition in the Internal Revenue Code, section 448D3, that talks about what a tax shelter looks like for tax purposes. So as long as your gross receipts are under $27 million and you're not considered a tax shelter, then you can expense certain costs and not have to capitalize them. So finally, prepaid farm supplies. If you use the cash method of accounting and your prepaid farm supplies are more than 50% of your entire farm expenses, you may be limited on what you can deduct in the current year. You may have to carry some of that prepaid expense over to a future tax year. So in line 10, for car and truck expenses, generally you would need to complete IRS Form 4562 to capture those expenses. So you can elect to either use the standard mileage rate or deduct actual expenses incurred. So, but there are certain limitations where you can only do one or the other. So you must use actual expenses if you have 5 or more vehicles that you used in your farming business. Like if you have a fleet of vehicles, you have 5 or more, you have to use actual expense method. But if you leased a vehicle and you previously used the standard mileage rate, you cannot use the actual expenses method. You have to keep using the standard mileage rate. And you can only take the standard mileage rate if you own the vehicle and used it and used the standard mileage rate previously, or if you lease the vehicle and you're using the standard mileage rate throughout the entire lease. So if you use the standard mileage rate, there is a mileage rate specifically prescribed by the federal government. You would apply that to the amount of business miles that you've driven. We have covered that in a little bit more depth in our IRS Form 4562 instructions. You would also add any parking fees and tolls, and you would enter that total in line 10. If you use the standard mileage rate, you cannot deduct depreciation, you cannot deduct rent or lease payments, or your actual operating expenses. So if you decide that you're going to use the actual expense method, then you would include on line 10 the business portion of gasoline, oil, repairs, insurance, license plates, and so forth. Then you would show your depreciation on line 14, and then you would show any rent or lease payments on line 24A. So there is a difference. Make sure you're very aware of how to separate, the standard mileage rate versus the actual expenses. For chemicals, enter the cost of chemicals that you purchased during the year. In line 12, conservation expenses are generally deductible if they're used to conserve soil and water for land used in farming, if they're used to prevent land erosion, or for endangered species recovery. So this might include things like earth movement, like leveling, grading, conditioning, construction control, or the protection of diversion channels, drainage ditches, irrigation ditches, dams, outlets and ponds, brush eradication, windbreak planting, or site-specific management actions based in a recovery plan. So your deduction can't exceed more than 25% of your gross income from farming. And if your conservation expenses are more than that limit, then they can be carried forward and deducted in future tax years. But in a future tax year, you're still beholden to the 25% limitation. In line 13, you would enter any amounts that you paid for custom hire or machine work. Again, that was the item that you reported as income up here. If you paid someone to do that, in that the person brought the equipment, then you would enter that expense paid in line 13. Don't include any amounts that you used for renting vehicles. You would use line 24A for that. Line 14, depreciation and section 179 expense. So you can depreciate certain things like buildings, improvements, cars, trucks. So there's an entire separate form, IRS Form 4562, that breaks down depreciation. You can also use section 179 as an expense method where certain items of business property that you put into use, you can expense the some or all of that cost in the year that you put it into service. And you would make that election again on IRS Form 4562. If you have employee benefit programs other than a pension plan on line 23, you would enter the amount that you paid for those programs in line 15. So that might include accident and health plans, group life insurance, dependent care assistance programs. If you made contributions on your own behalf to a dependent care assistance program, then you would need to complete IRS Form 2441 to figure out how much you can deduct. If you made contributions on your own behalf to an accident or a health plan or a group life insurance policy, you probably can't deduct it on Schedule F, but you might be able to deduct the amount you paid for health insurance on Schedule 1. Even if you don't itemize your deductions, as long as the health insurance was for yourself, your spouse, and your dependents, you can claim that. You must reduce your line 15 deduction by any amount of credit that you might have received as a small employer for health insurance premiums. That would be on IRS Form 8941. In line 16, you're going to deduct the amount of feed that you spent. If you use the cash method, you can't deduct the cost of feed that your livestock consume in a future year unless all of the following apply. First, it was for the purchase of feed instead of a deposit on feed. Second, the prepayment had a business purpose and it wasn't just for tax avoidance. And three, if you deduct that prepayment, it won't materially distort your income. So that's a rather subjective figure. In this case, if this happened to be prepaid amount, it probably wouldn't distort your income that much. If it looked like this, then maybe it would. So you kind of have to think what would look, out of sorts, what would distort your income. Definitely refer to your accountants or tax professionals' suggestion on what the role is here. Fertilizers and lime, any expenses you would put into line 17. Freight and trucking, so you would enter those expenses in line 18, but you don't include the cost of transportation for any livestock that was held for resale. Instead, you would add that to the cost of the livestock, and then it would be capitalized, and then you would eventually see that as part of your basis when you resell the stock, the livestock. In line 19, you'll enter the cost of gasoline, fuel, and oil as a separate expense from your car and truck expenses. In line 20, you're going to deduct any insurance besides health insurance. So this could be farm business insurance. It could be employee accident and health insurance is reported on line 15, but any farm business insurance would be on line 20. In line 21, you would enter interest that you paid for a loan to the extent that it supports your farming activity. And so you would have to refer to interest allocation rules. You would also have to see whether or not your business interest expense is limited. That might be a limitation. IRS Form 8990 contains a little bit more detail about that. But what you would be looking for is in line 21A, if you received a Form 1098 for a mortgage, like from your bank, then you would enter the amount of interest that you paid here. If it was another loan that you did not receive a Form 1098 for, you would enter that amount in line 21B. In line 22, you're going to enter how much you paid for farm labor minus employment credits. So employment credits would be things like the work opportunity credit on IRS Form 5884, the empowerment zone employment credit on IRS Form 8844, the credit for employer differential wage payments on IRS Form 8932. So once you back those credits out, you would enter that amount here. You can't expense a cost that you already received a credit for. That's why you have to back out those credits. In line 23, you're going to enter the amount that you contributed for employee pension or profit sharing plans. Generally, if you have one of these, then you're going to have to file either IRS Form 5500 EZ, that's for a single participant plan, IRS Form 5500 SF, that would be for a small plan of fewer than 100 participants. Sorry, these are just Form 5500, 5500 SF, or 5500 if you have a retirement plan that doesn't meet either of those criteria. And you would file those with the Department of Labor directly on the DOL website. Rent or lease payments. So if you rented or leased a vehicle you would deduct the business portion here on 24A. Again, if you're using the standard mileage rate, you would not use that. If you leased a vehicle for more than 30 days, you may have to reduce your deduction by what's known as an inclusion amount. In line 24B, you would enter any amounts that you paid to rent or lease other property. Could be like land or pasture, things of that nature. To circle back to 24A, if you need more information, IRS publication 463 contains a lot of information about how to determine an inclusion amount and whether or not that will affect your tax, the deductibility of that expense. Line 25, you're going to enter the cost for repairs and maintenance. So repairs and maintenance are different from capital improvements. So improvements generally make your property more valuable. They restore parts of your property, or they are adapting your property to a new or a different use. So if you have an old barn and you replace the roof on it, technically that would be an improvement because you're restoring a function of your property. If you painted the sides of the barn, then that would probably be under repairs and maintenance. So again, your tax professional is going to have a little bit more understanding of what would be an expensed cost and what needs to be capitalized as, you know, and treated in a different manner. Seeds and plants, storage and warehousing, and supplies, all of those costs you would enter in 26, 27, 28. In line 29, there's a long list of taxes that you can deduct, to include real estate and personal property taxes for farm property, Social Security and Medicare taxes that you paid to match what you're required to withhold from employee wages, federal unemployment tax, federal highway use tax, contributions to state unemployment funds if they're considered to be taxes under state law. However, you cannot deduct federal income tax. You can deduct half of the self-employment tax on Schedule 1 if you are self-employed, but you can only deduct 1/2 of that on Schedule 1. You can't deduct any of that on Schedule F. You can't deduct estate or gift taxes, taxes assessed for improvements, taxes on your home or personal use property, state and local taxes on property purchased for your farm. So if you bought the farm and you had to pay the state and local sales tax, you would add that to the cost of the property, and then when you turn around and sell it, that's how you would recapture that because it's already in the basis. And other taxes not related to farming, so you can't include any of those. Under utilities, include all of your utility bills, gas, oil, water, things of that nature. You can't deduct the first telephone line into your residence, even if you use that for your farm business. However, you can deduct second and subsequent phone lines. So the IRS considers either in a farm or a regular business that if you're working out of your house or if you have a farm that's co-located with a personal property, the first phone line is considered a personal use in almost all situations. Subsequent lines can be used as tax deductions. In line 31, you would enter any veterinary, breeding, or medical costs. In line 32, there is a long list of other expenses that you can also include. We go into a little bit more detail about the deductibility of those expenses in the article, so I'll just make this one point here. If there are negative adjustments, then you would have to include them down at the bottom as a negative number. And then generally with any number that's in line 32F as a negative number, for example, if you had pre-productive period expenses that you're capitalizing, then you would enter that negative number here, and then you would enter 263F. And you would enter that amount here. So there we go. But there's a whole slew. We go into much more depth in the article. So we get to the bottom of this and we add up all of the expenses, which happen to be $25,000, and we're going to subtract that from our line 9 account. And again, this is either if you completed part 1 or if you completed part 3 and carried the number up to line 9, you're still going to include that. You're going to subtract the total expenses from that amount. And we have this as $75,000, and then you would report that as your profit or loss on your tax return. So if you're reporting a profit, that's fairly straightforward. If you're reporting a loss, then you may need to make adjustments based on passive activity rules and also at-risk rules. So in line 35, this is reserved for future use, but then line 36, all investment is at risk or some investment is not at risk. So what that means is if you have a non-recourse loan, a loan that you take out and you don't have to pay back, it's not collateralized, it's just, oh well, we'll see what happens, then that's not really your money at risk. You're not responsible for repaying it back. If you had cash or property or borrowed amounts that are protected against loss by a guarantee, a stop loss agreement, or if you had any amounts that were borrowed from someone that has an interest in the activity but is not a creditor, like if someone's just throwing money into it, if they're a related person and they're giving you money, then you can use air quotes and call it a loan, but it's not really investment at risk the same way a bank loan would be, where you borrow money from a bank and you're responsible for paying it back, or you give up the property. So in this case, John Doe, everything's at risk, but if it's not, then you may be subject to at-risk rules, and you would probably have to complete IRS Form 6198 if you had a loss to determine the limitations on your ability to deduct that amount. And then again, in our article, we give you further guidance on where to report these on your tax return based on whether you're a partnership, individual, or trust and estates. So make sure that you kind of understand where to report this once you jump off of Schedule F. And it's also important to understand how Schedule F might interact with some of the other tax forms. So in our show notes, we're going to include links to the other articles that are either mentioned in the video, in our article, or on the form instructions so that you can go to that video or go to that article and get more information about that particular tax form. That about does it for Schedule F. If you like this article or video, we go into much more detail in our article, which you can find on teachmepersonalfinance.com. Type in IRS Schedule F, and you should see our article. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.